thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew. Big changes afoot in the tax treatment of several mutual fund schemes and categories. There are more questions, I think, than answers at this juncture. I'm talking about an amendment to the finance bill that is proposed that is yet to be tabled. And it suggests that the tax treatment of specified mutual fund schemes will be similar to the change that was proposed for market-linked debentures. What that means is that all gains arising out of schemes that have an equity allocation of less than 35% would be treated as short-term capital gains. So effectively, that would mean that indexation benefits that accrue for long-term capital gains, which would kick in post 3 years, would now not take place if that is to be passed. I'm joined by Radhika Gupta, the Managing Director and Chief Executive Officer of Edelweiss Mutual Fund and the Vice Chair of AMFI. Radhika, I think it would be fair to say that this is a bolt from the blue. Any idea at this juncture what the ambit of this would be?
So it is a bolt from the blue, if it were to be passed, and I'm still hoping that the powers that be that making decisions are rethinking about this being passed, because I don't think the implications are very good. If this were to be passed, I think the implications would be adverse on a number of categories of mutual funds. The ambit, in my understanding, is any mutual fund, regardless of category, that holds less than 35% in equity shares. So that means all your debt mutual funds. It means things like gold ETFs. It means international funds. It even means fund of funds investing in a combination of equity mutual funds. So really, and it means select hybrid funds also. So the ambit is truly very wide, first.
The question mark, and this is obviously a conjecture at this point because we're still seeking clarification, as I understand also AMFI is also seeking clarification to understand what this is about. But I stress on debt mutual funds because last I checked, 12.3 lakh crore in assets under management. It's a growing category. The question mark was that pure debt funds have no equity. So will they fall under this ambit?
I think so. I don't think there's any reason they would not, because the reading of the circular is not equity mutual funds or hybrid funds with less than 35% equity. It's any type of mutual fund, irrespective of category, with less than 35% equity. And debt mutual funds certainly are a type of mutual fund with less than 35% equity. So my reading and conversation with various folks in the tax world also suggests that debt mutual funds very much fall into this ambit.
Let's talk about implications. And I would like to, of course, reach to the finance ministry to understand the rationale behind this thought. But let's talk about possible ramifications if it were to be passed. And let's do category by category. First, the largest, of course, debt mutual funds. You've been a driver of the Bharat bond scheme. Mutual funds are a very large buyer of government debt, which is the predominant debt that is bought. Would this have an implication on demand for the humongous supply that is to hit the market?
Yeah, I think it has first and second order implications in fixed income. The first order implication is obviously the product is significantly less attractive to consumers versus traditional instruments. And I do believe it's unfortunate because it comes at a time when a program like Bharat Bond, which is a government-sponsored program, has been wildly successful. 60,000 crores target maturity fund category is 1.5 lakh crores. And it just shows you the potential of debt mutual funds if gotten right for consumers, and consumer love is, I felt it over the last 3 years. So the category is growing, and this would be a little unfortunate because finally we are a nation of savers, and debt is an important part of people's asset allocation. So I think consumers lose choice, which is a problem. And incidentally, I think with Bharat Bond, India set an example as the first Ministry of Finance and state-sponsored corporate bond ETF to really be a success. The second order implication is what you said. See, everyone has been talking about the development of the corporate bond market, whether it's Ministry of Finance, whether it's government, whether it's regulators. And mutual funds play a very important role. They are buyers of government, state development loans, PSU paper like Bharat Bond. And they are the one domestic institutional investor that is not a hold to maturity investor, because we get in and out of securities. If you look at EPFO, if you look at insurance companies, these are hold to maturity investors. Liquidity in the corporate bond market comes from mutual funds because we come in and out. So there are second order impacts in terms of demand for bonds and liquidity of bonds both.
Okay. In terms of the buyers of these schemes, my understanding, Radhika, is that there are a large number of institutional buyers of debt mutual fund schemes. What is the average holding period, though? Is there any understanding whether these investors generally hold for more than 3 years?
See, there are two categories of debt funds broadly. One is funds that are held under 3 years and they are used for cash management. And I don't think they're going to be impacted. Those are largely used by treasuries. The second is funds that are held for over 3 years. It could be target maturity funds like Bharat Bond or actively managed debt funds, corporate bond funds, all of this stuff. The buyers of those are a combination of corporate treasuries, institutions, family offices, HNIs, and individual investors. And the holding period can depend. It can be 3 year, and we have a product that matures in 2037, so it can be 15 years. So I think the range is really vast, but 3 to 5 years is where I would say a bulk of the money is.
A lot of the communication and narrative over the past several years that I remember, Radhika, is galvanizing people to move out of fixed deposit and traditional products and into debt mutual funds. And the biggest selling point was this indexation benefit. If this were to come to pass, do you see a reverse migration taking place?
I definitely think people, I wouldn't like to say it, but I definitely think, it's a non-trivial impact. So will people look at other options? Of course they will. They look at listed bonds. And then incidentally, there's a tax arbitrage that exists with listed bonds. So, you can buy a listed bond and there's still long-term capital gains taxation. They may look at listed bonds. They may look at traditional deposit instruments. Yes, will people look at options? Of course they will look at options. I mean, tax is not a minor thing.
What about outside of debt? Now, here's where it gets a little bit hazy, right? Because I think to a certain extent, tax arbitrage has existed in several categories. International equity mutual funds have fallen under that particular arbitrage because essentially they're equity, but they're treated as long-term capital gains post 3 years with indexation benefits, which was a draw. I guess to a certain extent, one would say that that's a fair correction, but not the way that it's being done, I guess.
Yeah, I mean, it's. I think it's an unintended consequence of something that has been written, in my understanding. But yes, I think they go from being taxed on average with indexation from 10 to 15% to 35% in a marginal rate of case. So again, when the rate of taxation jumps this much, you tend to make more comparisons. You will make more comparisons with international versus domestic. Not that that's necessarily the right comparison because they're different parts of the asset allocation, but will it cause consumers to think more? Yes, it will.
Now, finally, as a representative of AMFI, the vice chair, I'm trying to understand what the industry's reaction to this is, because my understanding again is that you've been caught by surprise as much as we have. So how does the industry move forward?
I think the industry is going to make, is going to do every effort to put its best foot forward. As an industry, debt mutual funds are not a small industry. And to repeat, I think all of us believe that in a country of savers, you really have to get your act in fixed income right. So I think we're going to put our best foot forward and reiterate some of the points that we just discussed on this call.
Especially considering the penetration could be significantly more than what it is right now.
I think penetration impacts on the corporate bond market, the fact that we are buyers of government and public sector bonds, our contribution to liquidity, because liquidity has been an issue that multiple stakeholders in the ecosystem have spoken about for many, many years.
Absolutely. Thanks so much, Radhika, for agreeing to do this short notice. You're joining in from the US. Thanks so much for taking the time.
My pleasure. Thank you.
Thanks.